Hello and welcome to another episode of the Minor Issues Podcast. I'm Mark Thornton at the Mises Institute. Well, feces comes in many different colors. The typical color is brown, and that's very fortunate for my talk today on the road to hyperinflation. It turns out that the color brown can be derived from the color red, which is, of course, symbolic for debt and credit. And if you add the color green to the color red, you get the color brown. And green, of course, is symbolic of the paper money of the United States of America, also known as the greenback, the money that we use in day-to-day transactions. Before we get to my analysis of where we are on the road to hyperinflation, there are a couple of housekeeping details that I wanted to go over that I've been meaning to go over for quite some time. The first is our annual contest this year of Bitcoin versus gold, where people guessed what the relative performance of Bitcoin would be versus the performance of gold over the year 2025. Now, as of midweek, September 4th, Bitcoin is at an all-time high, actually, and it has risen 17.9% so far this year as of today. Gold, on the other hand, is also at or near an all-time record high, and it is up 38.2% for the year. So the number, if you guessed it exactly correct, before January 1st, 2025, the number would be 0.47. Now, most of the people who took guesses into the contest guessed a number, I think it was about 2/3 of the people guessed that the number would have been greater than 1. In other words, Bitcoin would outperform gold. And it's been neck and neck. Both commodities have been up on the year. Doing very well, doing better than the stock markets. So Bitcoin is up. It's at near record highs, but it's not performing as well as gold so far this year. Of course, everything can change. We're going into September, one of the more volatile months for stocks and commodities. So stay tuned. The other update that I wanted to make was on a podcast episode that I did in early May on the gold to silver ratio, which is a measure of what's going on with the relative performance, the relative standing of gold versus silver. So back then, in the first week of May, the gold-silver ratio was actually about 104, which was really at all-time high levels. And a couple of months later, as we get into the beginning of fall, we see that the gold-silver ratio has fallen, as I kind of expected, but it's fallen to 87. That's a very big fall, and as I pointed out in the episode, when things change with the gold-silver ratio, they tend to change pretty dramatically from year to year. So both of those metals have gone up during the year, and they certainly have gone up since the early May episode. It's just that silver has greatly outperformed gold over that period of time and has gone up in a relative sense. Gold up relative to silver, and that tells us a good deal about how volatile things are and what direction the precious metals are going in. As I said, numbers over 100 with the gold-silver ratio are extremely high and aberrations historically. So that number could continue to fall over time. So both of those sets of information, they're not just housekeeping details, but they actually provide some information that is evidence for my case that the U.S. is actually, that we've actually driven up onto the road to hyperinflation, or at least we've driven up onto the on-ramp for the road to hyperinflation. Now, as background here, I'm going to link my review of a book that I did the book was by Professor Eichen Green, and his 2011 book called Exorbitant Privilege. And in the book, Professor Eichen Green looked at the U.S. dollar's role as a reserve currency, as the main currency that central banks held as reserves, as well as the currency that's used in international trade. And the fact that the U.S. had the premier position in the globe as the reserve asset for those two really critical functions made that an exorbitant privilege, in the sense that the U.S. Could kind of continue along the lines it had during Bretton Woods, where it could print money and sort of foist the cost of inflation on the rest of the world. Now, in the book, the good professor thought that the dollar's reserve status was really solid, and he saw nothing on the horizon which would threaten the U.S. dollar as the world reserve currency. He thought that maybe over a long period of time we would get a new set of junior partners as the reserve currency, that maybe the euro would be diminished somewhat, and that maybe the Chinese currency would be in greater use in international trade and as a reserve asset in banks. And when we talk of currency as reserve assets in central banks, we're usually talking about central banks buying government debt. In the U.S.'s case, the U.S. Treasuries that central banks would hold as reserves that were earning interest. Now, so he didn't see any risks to that, any threats to the U.S. dollar's standing, and that it would not be dethroned except by, quote, serious economic and financial mismanagement by the United States. Well, you can see in my review of Eichen Green's book that he dismissed gold as a reserve asset is something that was inconsistent and it was inconvenient with the needs of central banks, and that central banks had no interest in using gold as a reserve asset, and so that really wasn't a threat either. And so therefore he thought that there would be no crash in the U.S. dollar, and there would be no disappearance of the role of the U.S. dollar, because he thought that it would require continuous runaway U.S. spending, a loss of confidence by investors in the U.S. dollar, and it would require China dumping the dollar as a reserve currency. Now, as I point out in the review, all of these things that Eichen Green dismissed are precisely the reasons why I thought at the time of the review, and I did beforehand as well, that the U.S.'s role, the dollar the dollar's role as a reserve currency was in serious jeopardy, and that all the reasons that Eichengreen gave for saying the dollar was golden are the same reasons I thought the dollar was at risk and that it might crash and that we would lose our monopoly reserve status. In fact, I criticize Eichengreen because he fails to seriously question the status quo at all. And, in my thinking, that would be the only reason to write such a book, would be to seriously question the status quo along some metric, whether it was theoretical, whether it was public choice oriented, whether it was historical, simply the fact that other reserve currencies have lost their status in the past. So I urge you to check out my review and Eichengreen's original book. Now, another thing I've talked about and have talked about on this podcast is Mises's view of inflation, that there are three stages. The first stage is, where people don't expect any inflation. They expect the money to maintain its value. And so when the central bank increases the supply of money, people don't diminish their demand for money, and they simply absorb the new money into their cash balances. So that's really stage one. In stage two, the government inflation, the printing continues. People stop adding to their cash balances, and prices start to go up, and people's experience and their expectations of the future start to change. And so in the final stage, the government, the central banks are continuing to print, they're continuing to inflate, and the people sense that inflation is an ongoing, possibly upward trending phenomenon. And so then they actively decrease their demand for money. Of course, the overall economy can't decrease the quantity of money by reducing demand, but the reduction in demand, at the same time you get an ever increasing supply of money, means that the purchasing power of money is going to be depreciating even more rapidly. Okay, so those are the three stages. Mises used those as a way of understanding the Germans' reaction to hyperinflation in Germany in the 1920s. So what sort of things do we look at today to see possible evidence of a similar type of behavior? Well, of course, in the United States, when we were on the gold standard, and even when we were on the Bretton Woods gold standard, prices were very stable, and people didn't get a sense that there was a lot of price inflation in the economy. They didn't have any idea if there was monetary inflation, even though there was some inflation by the central bank. There was growing debt on the part of the government, and so expectations for inflation were fairly subdued. But of course, that was shaken first in the 1970s, when we had high rates of inflation from 1970 to the early 1980s. And then there was a rather long interlude when inflation and inflation expectations were more subdued, until they were recently awakened with the COVID inflation and subsequent events. And so in stage two, once people realize there's price inflation, they stop increasing their demand to hold cash balances in the economy. They'd rather have something else that holds its value. And then, of course, in stage 3, people want to actually actively diminish their demand for money, their cash balance holdings. And so we see people adjusting their expectations and reacting to Fed policy. And this is where the rate of price increases can accelerate rapidly. And that's why I say we're still maybe on the on-ramp to the road to hyperinflation, because technically or statistically, hyperinflation is when, prices are rising by like 20% per month. Some people define it as 50% per month, something that we, for example, see in Venezuela, and we've seen in other second and third world countries really throughout history, throughout modern history. So what do we have going on today that's really affecting this? Because I've talked about Mises' stages, and I've talked about all of these factors, but I've never put them together in one episode. So the first thing that is important to realize is the U.S. and European sanctions against Russia, and specifically the fact that the U.S. basically stole Russians billions of dollars of U.S. Treasuries as a sanction. And, of course, that was immediately an aggressive threat that countries around the world recognized. They recognized that, hey, the U.S. government, who knows who's going to be in control? It could be, not somebody really with it and stable and dependable and honest, but it could be, somebody, some crackpot, some airhead, and some criminal, basically, that's going to take all of our all of our central bank reserves. So in response to that, we've actually seen central banks diminishing their holdings of U.S. government securities, and we've seen moves on the part of the BRICS countries, that organization, to get away from the SWIFT financial transaction system. They're currently setting up their own financial transaction system where they'll be able to engage in international trade transactions that are beyond the reach of the U.S. Government and its allies. And the system supposedly is partly based on gold. It's technologically further advanced and better in some other respects, but that's on the beyond the drawing board at this point. So central bank reserves are now, in terms of gold, have now surpassed the U.S. government treasury or bonds for the first time. And this new financial transaction system is now getting up and running. And so those are factors that I think are important, because central banks are reducing their demand to hold U.S. denominated assets. Another thing that is a wild card in all of this are President Trump's sort of arbitrary and unilateral tariff policy, which most other countries in the world consider a threat. They consider an aggressive threat, that it seems to be completely personal and discretionary. It's not transactional at all from their point of view. It's like a thief in the night with a knife in your back type of an approach. And so, in all of those respects, we see foreign governments, in particular central banks, they are getting out of the U.S. dollar and government bonds. And so that's obviously a big problem in where the underlying condition, of course, is that the U.S. is borrowing more and more and more money, that the interest on the debt has skyrocketed very quickly in just the last couple of years to enormous levels. And of course, the budgets are more unbalanced, more in the red than ever. So that's an independent threat to U.S. bondholders and U.S. holders of any kind of dollars, any kind of dollar-denominated assets. So central banks, we know, we have evidence, and a lot of it, that they are dumping dollars in favor of gold. If we look at Americans, I think they're not really well informed about all of this. The current generation, but because of economic conditions and relative prices in the economy, we find that a lot of people are holding what might be considered excess investment in housing. They're holding maybe more than one house. They're holding a house that is much bigger than their needs. They might otherwise, if prices were different, they might actually downsize, but currently they're over, real estate agents might consider them over invested in things like real estate. But from our perspective, that over investment in real estate is a protective layer against price inflation, because the values of homes can rise with inflation, just like the value of gold at foreign central banks. And also, speaking of that, there are, of course, a lot of old farts in the current generation that are actively investing in gold and silver and precious metals, both in the United States and in many other countries around the world. This is, the U.S. is not alone in this problem of a possible currency emergency. Certainly Japan and the United Kingdom, potentially the euro, and other currencies around the world are all kind of up in the air here. Our focus is on the U.S. dollar as traditionally the best of the fiat currencies, or the strongest, I should say. I wouldn't want to say best, but the strongest of currencies. And then, so we've got, pockets of the American population who are actively reducing their demand for dollars and cash balances and investing that money in precious metal investments that are better protected against a falling U.S. dollar or other fiat currencies. And finally, of course, we have some of the younger generation who are not turned on to any of the traditional investments and are mostly turned on by things like cryptocurrencies, Bitcoin, and then, of course, one of the selling points for crypto and Bitcoin, the cryptocurrencies, the crypto coins in general, and Bitcoin in particular, is that it helps protect the investor against inflation. So we do have evidence that there are good reasons why people are adjusting their expectations and moving into Mises's third stage of inflation expectations. And we also have good evidence that there are groups, both globally and domestically, that are moving out of, actively moving out of holding U.S. dollars, cash balances, and moving into things that where their wealth is protected against the losses that are brought about inflation. Of course, not many people are actually expecting any kind of hyperinflation, but if we look at Mises's overall theory and analysis, we should realize that we're probably moving in that direction, and that it would take a really serious, sustained, intellectual and revolutionary type chain of events to turn that whole thing around.